Many people have jumped on adjustable rate mortgages to require advantage of the traditionally low interest rates we've got seen over the previous couple of years. Rates square measure currently rising, which implies you would like to grasp caps. Adjustable rate mortgages, talking regarding rate of interest caps. An adjustable rate mortgage is simply what it appears like. The rate of interest will be adjusted to match sure rate of interest standards. The advantage of such a loan is it will seriously lower monthly mortgage payments if interest rates square measure low. Over the previous couple of years, of course, rates are implausibly low. Rates square measure currently rising and you would like to grasp what which means for your adjustable rate mortgage. Since the rate of interest on your loan is adjustable, you ought to be obtaining a bit nervous regarding rising interest rates. That being aforesaid, most loans have graduated step will increase and caps that keep things from obtaining blood-curdling too quickly. Here could be a nearer look. A good adjustable rate mortgage protects you from huge rate will increase through one thing referred to as rate caps. Their square measure two kinds of rate caps, every has advantages and negatives. A lifespan rate cap is simply what it says. This cover sets the most rate of interest the loaner will charge you for the loan. You need to invariably demand a lifespan cap on any mortgage you're taking out. Assume you're taking out associate in nursing adjustable rate mortgage with associate in nursing rate of interest of 4%. As a part of the agreement, the loan includes a lifespan cap of 8%. If interest rates increase to 10%, your loan can cap out at 9%, whereas this can be a high rate of interest, it's plenty higher than paying 10%. Periodic rate caps can jointly defend you, however in an exceedingly completely different manner. Adjustable rate cap outlined the most share your rate of interest will increase over a period of your time. The shorter the fundamental quantity, the higher the cap. If your loan document permits the loaner to regulate the speed each 6 months, the cap could also be as low United %. This suggests the loaner will solely increase the rate of interest by a most of 1%, in spite of what the market is charging for brand spanking new loans. Adjustable rate mortgages square measure nice once interest rates square measure low. Once rates begin crawling up, however, you would like to require a detailed look into your caps. Adjustable rate mortgages, this home loan might not be for the weak at bottom. I detected the news regarding another rate of interest hike and thought it had been regarding time to seem into refinancing my mortgage. I contacted my mortgage company initial. I am fascinated by a hard and fast mortgage rate. I said. May I raise why that is? The broker asked with courtesy. I don't need to take care of the chance of rising interest rates. At my age, I cannot afford the chance. Looking at your last 10 years of history, you've got done practically with the adjustable rate. In fact, you had paid less in interest than the majority with a hard and fast loan. Could I counsel that we glance at some adjustable rates, that square measure even but the speed you're paying, and with caps you don't ought to worry regarding the rate of interest hikes. I believe we are able to prevent a number of hundred greenbacks off your monthly payment. At this time the broker took a breather, so I will say, no thanks. I am solely fascinated by a hard and fast rate mortgages. I do not perceive, square measure you not fascinated by saving money? He asked before launching into a lecture that had a combination of Economy 101, Budgeting 1, a touch of fortune-telling and a healthy and entirely unreasonable optimism of future trend in interest rates. When he was done I explained to him that I recall the 18% to 19% interest on mortgage loans within the early 1980s that he appeared too young to recollect. I identified that on a $100,000 loan, the 18% interest as $1,500 per month on the mortgage interest alone. If you've got a $200,000 loan, the interest alone would be a back-breaking payment of $3,000 per month. I knew he thought I am out of my mind puzzling over associate in nursing 18 mortgage rate of interest in today's setting. At the tip, we tend to over-the-phone speech with none resolution. The gap in understanding wasn't regarding mounted rate mortgages versus adjustable rate mortgages, ARM. The gap was in age, experience, expectation, hopes and fears, a niche too wide to bridge. To understand this gap, let's look into the adjustable rate mortgages. This kind of loan is typically below the mounted rate, and therefore the lower rate means that lower payment that successively means that easier qualification. When lenders square measure considering your loan application, they appear at what share of your financial gain is offered for repaying their loan. With associate in nursing financial gain of $5,000 per month, a $2,000 loan payment as 400th of your financial gain and a $1,000 payment as 200th of your financial gain. The nearer you get to $1,000 or 200th of your financial gain, the better it's to qualify for the loan. This easier qualification appeals to younger those that square measure simply beginning and people with financial gain limitation. Adjustable mortgage rates charm to adolescents with associate in nursing innate optimism, hopes of exaggerated financial gain and therefore the high chance of moving to a unique point a brief amount of your time. They have to seem at what they'll afford to pay and can't worry an excessive amount of regarding the distant future. To them something is healthier than dealing that as absolute waste of cash. There also are those older people World Health Organization have suffered from some setback in life and don't fancy a high credit score or don't have a really high financial gain. Since a poor credit score will increase the rate of interest a bank offers to potential borrowers, a hard and fast rate could also be too high for these people to think about. Let's take a glance at some terms that assist you perceive ARM higher. Margin, this can be the lender's markup and wherever they create their profits. The margin is additional to the index rate to work out your total rate of interest. ARM indexes, these square measure benchmarks that lenders use to work out what proportion the mortgage ought to be adjusted. The lot of stable the index is then the lot of stable your adjustable loan remains. Think about each the index and therefore the margin once you square measure searching around. Adjustment amount refers to the holding amount within which your rate of interest won't amendment. You may come upon ARM figures like 5-to-1, which means your mortgage interest remains an equivalent for 5 years so it'll change per annum. Interest rate caps, this is the most interest a loaner can charge you. Periodic caps, the lenders could limit what proportion they'll increase your loan among associate in nursing adjustment amount. Not all ARMs have periodic rate caps. Overall caps mortgage lenders may additionally limit what proportion the rate of interest will increase over the lifetime of the loan. Overall caps are needed by law since 1987. Payment caps, the most quantity your monthly payment will increase at every adjustment. Negative amortization, in most cases a little of your payment goes toward paying down the principal and reducing your total debt, however once the payment isn't enough to even cowl the interest due, the unpaid quantity is additional back to the loan and your total loan obligation is exaggerated. In short, if this continues you will owe over you started with. Negative amortization is that the doable drawback of the payment cap that keeps monthly payments from covering the price of interest. As you compare lenders, loans and rates, keep in mind Sculptor World Health Organization aforesaid, what's necessary is looking for what works for